Hello and welcome to another episode of Nothing Ventured with me, Aarish Shah. Today in the studio with me, I had Joe Knowles. Joe is a partner at Smedvig Ventures, a venture firm with a twist, a single LP, patient capital, and a 30-year track record that doesn't bend to hype cycles or chase unicorns for the sake of it. Joe's been on both sides of the table, Airbus engineer, investment banker, startup founder, before spending the last decade backing high-growth B2B companies across Europe. At Smedvik, he's building a portfolio where $300 million exits are worth celebrating, where integrity and founder trust are the strategy, and where the model isn't predicated on catching a once-in-a-generation outlier. In today's episode, we talked about how the power law is not a myth, but
the power law is absolutely not a myth.
Yeah,
it's very real.
Why talent, capital, and belief are important, how over the last 15 years there have been around 15,000 VC-backed companies in Europe, but how only 130 deals represented 40% of the 600 billion euro exit value.
It's a really interesting, very high value segment where the value is much more evenly distributed across many more companies.
How a single LP fund gives Smedvik the best of both worlds, and how dependence isn't an issue.
I actually don't think of dependence as an issue, really. It's not come up for us at all. I think as long as you're generating good returns, things are good.
How we're in a golden age for value creation, and why the commoditization of code means execution becomes even more paramount, and why domain expertise becomes a niche.
The domain expertise of founders is that very unique, so there's just a lot of know-how that you can't replicate the code.
Finally, whether Europe's physical infrastructure can keep up with its ambitions.
The thing I worry about is literally the physical infrastructure.
Let's get straight into it. Hey guys, whilst I've got you here for a second, I just thought I'd reintroduce myself. My name's Aarish. I am the host of Nothing Ventured, the podcast where I talk to the people behind the stories that make the venture ecosystem go round. I'm also the founder of Emerge One, a consultancy that provides fractional CFO support to venture-backed tech startups from seed to Series B and beyond. If you enjoy the podcast, we'd really appreciate it if you could like, comment, subscribe, and give us a great review wherever it is that you listen. And of course, if you want to get in touch to discuss anything with me, whether it's about future guests or what you think about the pod, do reach out to me. I'm on LinkedIn and Twitter and always enjoy a natter. Right. Let's get into it. Joe, really great to have you in the studio with me. Thank you so much for joining. And actually really great to have you here as kind of one of my first guests in this new season, partly because you came highly recommended by multiple founders when I asked, who should I be speaking to? So it is a real pleasure to have you here today.
Great to hear.
Amazing. Well, look, we're gonna jump in. We talked a little bit about this during the quickfire, but I want to talk about the kind of power law myth, and this is a topic that I think has come up a few times now in conversations I've been having on this podcast. We all know that VCs in general love to preach about the power law, right? Chase the 1 in 100, everything else be damned, looking for the decacorn, etc. Right? You've said that isn't necessarily Smedvig's game. So I guess my challenge to you is this obsession with unicorn hunting actually weakening venture returns overall? And if we were to stop hiding behind power law, how do you think industry behavior might change? And would that be a change for the better or maybe the worse?
Great question. And I think I should probably start by saying that the power law is absolutely not a myth.
Yeah.
It's very real. I think whichever way you look at it, most VC-backed companies fail, and a very small percentage of them generate a huge amount of the return. So I'm not really disputing that. I think what's interesting is that the industry tends to interpret that very crudely.
Very narrowly. Yeah.
Very narrowly, yeah, exactly. And that I think there's sort of two interesting things that come out of that. Firstly, you basically have all funds taking the same strategy, which is try and find that very small percentage of outlier companies.
Mm-hmm. Of which there is a very small pool, right?
Exactly.
So it either means you're chasing the same business or you are looking for ever riskier assets, right? Potentially, I guess.
Exactly. And I think there's probably thousands of funds chasing tens or at best 100 or so companies. So it feels like a losing battle, really, especially when you add in the layer that actually there's a small number of funds who have been proven to be sort of strategically advantaged at finding those companies, the tier ones, let's call them. And so for everyone else, it's, again, even more of a losing battle to some extent. But I think much more interesting and positive, really, is that one of the features of a power law is those outliers skew what it looks like and make everything else look sort of irrelevant relatively. But actually, that's not true. There's a whole kind of swathe of companies in the next part of the curve which are super valuable, super interesting, lots of them. And I think that's a really interesting place to play as well from a fund perspective. I think both strategies are legitimate and both are important to the ecosystem, but I think the latter is possibly a little bit overlooked, and I think it's a very interesting place to play.
Yeah, and this is a theme, as I say, that keeps coming up. And I don't know how much of it is a theme that some VCs have sort of cottoned onto, because obviously things have changed over the last few years, I would say, or if it's some animal spirits that are finally actually coming. Like everyone, I think when I got into the venture ecosystem 10 years ago, I was always baffled by the relentless pursuit of nothing but, power law returns. And that was then, I guess from my perspective, really around, okay, why revenue at all costs and all of these sort of things, right? Where you're just chasing unprofitable revenue was somehow vindicated by, massively high valuations. And it feels like, obviously, we all know that that's all reset quite a lot. And I wonder whether this was just like a nascent feeling that a lot of VCs, and certainly VCs that probably came into the ecosystem over the last decade or so, possibly, have been feeling. I mean, that no one wanted to say out loud that you can chase something other than the power law return sort of companies, but it feels like more and more VCs, and certainly more and more VCs that I've had on this podcast, are starting to say that, which I can only imagine is a good thing, because what I think that then means is, yes, you will always hope that you will have some of those outliers in your portfolio, for sure, but you can get really good results out of that middle swathe, as you say.
Exactly. And I think both are important to the ecosystem, and they're actually more symbiotic than you might think, because actually if you get those outlier businesses, that creates talent, that creates capital, and that creates belief, which has a multiplier effect. And actually people spin out of those companies and found companies in that next tier down, and actually it's the outliers that then become acquirers of lots of those businesses. So I do think it's actually quite a virtuous circle between those two strategies.
Yeah, and I mean, without being, at the risk of stating the obvious, right? If you have great outcomes, in fact, arguably, for businesses, i.e. they aren't just going to zero, then that's a net positive, not just for the ecosystem, but for the economy, for jobs, for employment, for growth, and ultimately, again, to your point, if you have some of those larger outcomes, or even the sort of middle tier outcomes, which could still be in the hundreds of millions, that provides the potential capital to acquire the smaller companies, etc. So you get this recycling, and as you say, this sort of positive virtuous cycle amongst all of these businesses. But you actually had some like very interesting kind of numbers that you put together on this. So do you want to talk through those?
Yeah, sure. I mean, at very high level, but if you look at Europe, over the last sort of 10 to 15 years, there's roughly 15,000 venture-backed companies.
Which is a lot smaller than, like, intuitively, I know that number's right, but equally, like, with all the kind of news and noise, etc., it feels like there's a lot more than 15,000.
Yeah, and it
over the last 15 years.
Probably skews more to recent years, so I guess the run rate is probably higher than that.
Yeah.
And roughly 12,000 of those have now reached some sort of conclusion. So if you look at those, about 3/4 didn't work out. If you include undisclosed exits, so probably maybe got some money back. Yeah, that's about 3/4
acqui-hires or whatever. Yeah,
exactly. So if you then zoom in on the 25% that had a material exit, that's about 3,000 companies. And what's really interesting is when you zoom into that, and so what you find is there's about 150 companies that exited for over €1 billion, only 150, so about 10 a year. And they did indeed generate about 40% of all the value. super interesting, great to go after them, but there's probably thousands of funds chasing those 150 companies. What I find really interesting is when you look at the next tier down, so 100 million up to 1 billion euros, there's about 1,000 companies in that range, and they actually generated slightly more, so about 45% of all the value, and almost 300 billion worth of exit value. And so I do think it's a really interesting, very high value segment where the value is much more evenly distributed across many more companies. And so that's why I think that is a very interesting segment to look at.
But from a venture perspective, I guess then the question becomes, are those mutually exclusive? Like, can you have a strategy that chases both? Does it matter? Because arguably the work that you potentially have to put in as a VC, as a director potentially, etc., in that middle sway to get to those outcomes may be more than the work you have to put into in those unicorn style businesses. Although I guess the caveat to that is the work of finding those unicorn businesses is potentially a lot harder, and is not, as we know, is not easy or is not guaranteed in any case, right? So but I mean,
I guess the work's probably similar, but just the hit rate and chance of success is different.
Exactly. And but can you pursue both strategies at the same time, or does it become a case of you pursue the power law strategy, but as you see these businesses that are graduating to good outcomes, but not necessarily the decacorn, as it were, do you identify them as and when they arise, and then lean in at that time?
It's a great question, and I think the truthful answer is no. You can't do the two ends of it fully. And to be clear, they're both power laws, right? So even if you're going after this middle tier, you still end up with a power law distribution. It's just, if you want to get nerdy about it, it's a different exponent to what you see at the top end. And so there's definitely overlap. So for example, if you're looking for businesses that exit for 200, 300, 400, 500 million, for sure, those businesses can also get to 1, maybe 2 billion. And so your investment model always has the expectation you might find those. Yeah. And indeed, if you look at our portfolio over the years, we've got some companies on that path. And if they happen to get to that end state, they'll turn a good fund into a very good fund. But the model isn't predicated on absolutely needing those. So I think there is overlap in the strategy at the kind of 1, 2 billion end. But the reality is, doing our strategy, we're not going to find a decacorn. And the reason for that is most of those kind of outcomes require quite a long period of faith, where you're backing something with negative economics, or you're investing huge amounts in gaining market share and developing a category. And it basically just needs big pockets. So you need billion-dollar funds to do that, and you couldn't do that simultaneously as a small fund pursuing our strategy. And the inverse is also true. It wouldn't really make sense for a multi-billion fund to be investing at the lower end, because that doesn't make sense in terms of their resource allocation either. So I think you can't do both. There is a slight overlap kind of in between where both can exist. But in general, I don't think you can do both strategies. No.
And do you think that the industry is kind of converging more on this sort of a strategy, where it's, especially again, right, with the developments in AI, and like obviously this becomes quite boring to talk about because everyone's talking about it, but software costs are reducing significantly, going to zero. Arguably, I think I don't necessarily think that AI is yet in a place where it replaces engineers, but it certainly makes engineers a lot quicker, or gives them gives them the ability to move faster. Do you think that, and as a result of that, actually where you deploy capital has also changed, because a lot of these businesses need less capital up front, and actually are only chasing those larger funds further on, because they can essentially bootstrap, seed strap, whichever way you want to look at their way through the A and B and go straight to C or D, because they've managed to kind of create the value or show the value early enough on. So I get, my point is my question I guess is, does this thinking lead to a fundamental shift in how venture operates more broadly?
It's a really interesting observation, and the truth is, it's quite hard to know at the moment. So in theory, the AI reducing or increasing productivity, basically, not just of devs actually, but of everyone in the business, should lead to more capital efficient businesses, because you can do more with less, simply. The reality is that's not the case on the ground, in that companies are raising more than ever. And the reason for that is because VCs see this opportunity and are trying to win markets, win categories, and take advantage of that opportunity. And it's not as irrational as it looks, because if you believe the end state of where some of these businesses can get to, it does make sense to invest the kind of sums that are being invested. Essentially, you're betting on not just disrupting the software stack, but the software stack starting to eat into labor costs. And thus it can be an even bigger market than it has been to date. I also think, actually, I'm kind of with you in that I don't think this is, take tech, for example, or devs. I don't think AI completely removes the need for devs. It just means your good devs, your more experienced devs can do a lot more, which actually means their value goes up. I think that's another dynamic that we're seeing, which means the increased productivity isn't actually translating to higher capital efficiency. But to sort of bring it back to the power law question, I guess in theory it suits our model, actually, because in theory you can get much more capital efficient businesses that need less capital, can chase potentially slightly smaller markets, because there's not that capital hurdle that means you have to justify a bigger market. So in theory that's great. But at the same time, what you also see is what you described, which is companies being low capitalization while they build, but then going for really, really big grow the market type GTM investments. And that does make it harder. The fundamental hasn't changed in terms of the market size. And so the risk is, do you just get too much capital chasing too many businesses on the hope that they could end up in that end state, which actually then blows up all of the middle outcomes that could have been really successful if you were more disciplined with your capital.
And that is, again, that reckoning seems to have happened again, right? So we're like 2.5, 3 years into the kind of AI gold rush. And obviously, if you spend any time on X, Twitter, the narrative has moved from, AI is going to solve everything to, well, can AI ever be profitable? And okay, hold on, how are we pricing these businesses, and so on and so forth. And so I think, which is a much, this was a much more condensed, faster path to get to, hey, maybe we should think about unit economics again, as compared to, say, the 6-7 years where it was growth at all costs, because that was a zero interest rate phenomenon. And it was only when interest rates went up and people went risk off, essentially, where investors started saying, well, hold on a second, actually, at some point, these do need to return something. And that was when we sort of saw this kind of flight to, you must be unit economic profitable. You can't just, juice your growth with capital. There isn't infinite capital anymore. You've got to be disciplined, et cetera, et cetera. And then we went into AI, which was like, okay, we'll do the same thing. But it took, only a couple of years to come back to, okay, well, hold on a second. Now it feels like we're in a bit of a frothy market. So I think, look, I mean, I strongly believe that the ecosystem over the course of the next, 3-5 years will change, because I think there's a lot of unknowns out there and a lot of outcomes that, that are being built today, which could change the shape of how we think about things in a year's time, in 2 years' time, in 3 years' time. I mean, the conversations I have with practitioners, with founders, I had a call with someone yesterday, who's building something in the B2B space, enterprise sort of space. And, it was founder, their question to me was, well, hold on, how AI does my business need to be? Because we do use AI. But what does that mean when I talk to investors? And I'm like, well, this is now the problem, right? At what point are you an AI enabled business versus an AI business versus just a business? Because all businesses at some point will be AI powered to some extent, right? And so I think what that does is it mixes up, and not messes up, but it changes the way venture, I think, needs to work, can work. And I think that one of the outcomes, to kind of just wrap it all up, is that we will see more and more funds chasing those middle outcomes, because the larger outcomes you know, I mean, yes, we've of course had lots of unicorns over the last 10, 15 years, but who does anyone ever really think about? It is the Facebook, it is the Amazon, it is Salesforce, maybe it is, you know, Uber, Airbnb. There is a very, very small cluster of businesses that are household name unicorns, and really generationally transformational businesses versus maybe realized, but, you know, essentially unicorn businesses that captured that status partly as a result of market dynamics, partly as a result of good marketing. And I think founders are also cottoning on to the fact that, okay, and you will always have founders with massive ambition that are chasing the $1 billion plus valuation, 100%, right? You and I both know that there are,
and there's
those
also
founders are out
a
there.
big divergence between paper unicorns and actual realized multi-billion exits, right? As those numbers show. Exactly my point, right? Because there's so much capital swimming around the market, you can remain private for longer. And now private equity is having issues because they've got the same problem. There's no one to exit to, right? So they're creating their own sort of continuation funds and all of this sort of stuff, right? Which, yes, is geek. I get it. It's geeky. It's annoying, whatever. But this is the reality of where we are. And so therefore I do wonder whether what that means is a lot of VCs will start looking at that middle swathe much more, with much more enthusiasm than maybe they have in the past. Because, you know, those could well be the fund returners. They could well, you know, provide the capital returns back to LPs, et cetera. So, yeah, I mean, I think my point is I think we're in a very interesting few years as all of this sort of unfolds. I'd like to move on, if I can, to Smedvig, because you're a single LP fund, right? Yes.
Which in my mind, I'm like, that's great because that's patient capital, and it's a single LP fund, which is essentially a family office, right? So patient capital, but equally kind of, I wonder whether there's an element of golden handcuffs within that, right? So obviously a single LP gives you the stability and freedom, but it also to some extent gives you dependence, right? So is there a hidden downside in the model? And in a world where raising a fund is, you know, frankly getting harder by the month, do you think we're going to see a quiet wave of kind of VCs morph into family office back kind of hybrid models?
Yeah, it's very interesting. And I guess I feel very lucky with our setup, which is a single LP fund, which is very different to a family office, actually. I think that's an important distinction to make.
Yeah.
And the reason I feel very lucky is because I think we get the best of both. We get the best of a sort of normal multi-LP fund in that we have autonomous GP decision-making, we have closed-ended funds, we can have carry structures which allow us to attract great talent, and we can have a closed-ended fund with a sort of normal VC strategy and return expectations. So all of those benefits. On the flip side, we also have the benefits that you might get with a family office, which is that we don't have to spend somewhere between 25 and 50% of our time fundraising. We do raise funds. We raise every 4 years, like any other VC, but we're raising from a LP that's been backing us for 30 years and knows us very well. So it's probably 5 to 10% of our time.
Just out of interest on that, because 30 years is, I mean, like that's a pretty significant kind of amount of time. So did the venture arm or did the venture fund spin out, or was it established by someone external, which the family then decided to kind of? Yeah,
it was set up as a separate business between the original founder, a guy called Johnny Hewitt, and Peter Smedvig, who was sort of the head of the family at the time.
Yes.
Basically because Peter was super interested in entrepreneurship, angel investing, private equity. And so it was set up out of that interest. And then over time has professionalized into what is now as I say, a sort of LPGP, single LP fund. And I think it's really that sort of funding point, the amount of time having to not spend fundraising, sort of, you know, joke around with other VCs about it, and you know, it's a luxury, but it's actually a source of competitive advantage, right? Because all of that time that we don't spend fundraising,
you're sourcing deals, we
can reallocate to working with great companies. So I think it is a genuine source of competitive advantage. So that's sort of all the positives. On some of the drawbacks, I actually don't think of dependence as an issue, really. It's not come up for us at all. I think as long as you're generating good returns, things are good. But that's the same at a multi-LP fund, right? You still have an anchor LP.
And you only have one hurdle rate to kind of get over versus a multi-LP fund. There may be expectations of what is good performance versus what is bad. You only have to have that conversation once.
Yeah. I think probably the only time dependence comes up is if you're trying to grow your fund faster than the overall assets of the LP, because they just end up hitting sort of rational allocation limits for the asset
And venture
class.
is almost always, I guess, like max 10-15% of kind of a diversified portfolio, right?
Exactly. And so I mean, that's not been an issue for us, because coming back to sort of where we sit in the power law, actually a big part of our model is fund size discipline. And we, the three partners, we all enjoy that sort of disciplined fund size and the model that we have. So we've not been pushing to grow AUM massively or massively grow the fund. We have grown it over time at sort of the rate of the capital return. But if you did want to significantly grow the fund, that's when it might be an issue. So I actually don't find the dependence a problem. Probably the biggest issue I've experienced over time is actually where you started in describing it as a family office, which is actually, it's a sort of branding, messaging challenge in that people don't really kind of, just because I haven't really thought about what an single LP GP means, there's sometimes a bit of a sort of hurdle to get over of being, well, we're not actually a family office. Not that the only reason that matters is I think historically there's been a sort of some negative connotations about a family office being, not having autonomous decision making, being a bit unpredictable, not necessarily being sort of venture growth mindset, being more about kind of owning assets, et cetera, et cetera. And none of those things are true in a single LP fund, especially when with the kind of LP we have. But it does just create a sort of messaging hurdle to get over, which we've spent a lot of time on over the last 10 years. Basically.
Yeah, there's a narrative you've got to make sure you've constructed. And I guess like there's two things, right? A, there is the opacity of family offices in a lot of people's minds, right? And then the second thing is, especially if it is a family office with an active business, is this just corporate venturing?
Yes.
And therefore am I actually, I've spent a lot of time talking to people about this recently. If you have typically it's a strategic investor, but if you had, for example, a CVC on your cap table for more than 15%, does that start smelling a little bit more like, okay, this is an exit, this is an option, or they have bought an option to acquire in the future, and does that therefore cap upside? So for other VCs coming in, it may look like a little bit difficult, whereas I don't get the impression that's the problem that you face with Smedvik.
No, and we're quite lucky again in that respect, because our LP has sold out of all of the original family businesses, which are basically shipping businesses. So they have a family office, multi-asset class asset manager, which is that is the business now. So there isn't any sort of corporate confusion like that. So again, we're quite lucky with that respect, but there's plenty of other family offices out there like that. So yeah, that's sort of the pros and cons. And you were asking about, do I think there'll be more of these?
Yeah. And the reason I ask is because I'm coming across more of them. Or maybe I think one of the things is maybe that, again, to that point around opacity, I think some family offices are shedding that kind of reputation for being opaque, for being behind closed doors and unavailable and unapproachable and so on. And so we've had a couple of guests on the podcast again who've maybe not single LP situations, but cornerstones, and very 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 open about the fact that their single cornerstone that their largest cornerstones are family offices, and that the fund essentially span out of conversations with that family office, rather than we're raising a fund, going and speaking to people. Okay, who are the LPs we should talking to? They started with the first LP kind of in the pocket, if I can put it that way, and then went out and brought additional LPs into the fund. So it might be sort of confirmation bias or observation bias maybe on my part, but it does feel like I'm seeing a bit more of that than maybe again 5-6 years ago.
Yeah, it could well be. I actually don't know, to be honest with you.
Sure.
I guess as families make more money, I suspect there'll be more pull into the asset class. What I've seen is, I mean, as we all know, venture is really difficult. And
family offices trying to go direct has been a problem.
It's a problem, right? Because it takes time to build up the institutional knowledge, the experience, the brand. Actually hiring the talent is very difficult. And so I think most families still choose to enter the space as a sort of LP into existing funds. But where you've got organisations like ours, where you have managed to build up a sort of consistent team that's been there for multiple generations, I think what we might see is those kind of businesses becoming multi-family platforms. So actually, when you've got a team in place, exactly what you described, you've got a team in place with a single LP, actually other families wanting to come in on that and building out a probably still small number of LPs, but maybe slightly diversifying. So and that's definitely happening. So I probably see that as more of a trend. And
I mean, I think so. The other thought that comes to my mind always with this, right, is yes, family offices or families tend to have much more patient capital, right, and that's clearly the case here, right? 30 years, they're in it for the long haul. How flexible does that allow you to be as a fund in terms of returning cash? Like, so, the typical venture model is whatever, deploy for 4, follow for 2, and then start harvesting from year 7 and hopefully close out the fund by year 10, 11. And we all know that exits have started dragging out to like 12, 13, 15 years, right? Especially with the IPO market where it is. So does that encourage you to be riskier because you can take those long-term bets? I always think about it in terms of like politics, right?
Yeah.
Which is really annoying because I hated politics until I started having to think about it. Where, part of the problem I think we have in the UK as an example is we take a short-term view because obviously you have an election every 5 years, whereas actually what you need is, a 10-year or 15 or a 20 or a 50-year view, right? So does the fact that you only have a single LP just actually mean that you can be not more creative, but more flexible in how you approach the deals that you do go into, but then also how you come out of those deals in the future, because you're not bound by this necessity to return the capital immediately, or is that still kind of the same? Does that structure still exist in the same way? And you still work to the kind of normal timeframes, and of course, even within more traditional multi-LP VCs, there's always a little bit of that anyway.
I think, to be honest, it's the same model overall. Our LP is as focused on IRR as any other LP is, so it's very much the same structure. I guess where you get at the edges where there's a difference, and you do definitely get more flexibility, is yes, you still go out and raise a fund every 4 years, and of course you'll get your return looked at. But if you've got solid returns over 30 years and you've got a good relationship, you just got a bit more flexibility. If the most recent funds, for whatever reason, you want to hold things a bit longer, you don't have to worry about, actually, I've got to demonstrate a short-term IRR because I'm going out fundraising again.
Yeah.
So at the margins, you get more flexibility, and perhaps more flexibility the other way as well, because you're focused on just getting a great return. You don't necessarily need the sort of, to where this conversation began, you don't necessarily need the Decacorn logos to go and get lots of other LPs excited. Yeah. And so you actually get flexibility the other way as well, because if it makes sense to sell a business for 500 and get a great return for your LP, you can do that. And you're not thinking, I really need to get a logo to tell a bunch of new LPs about. Yeah. So you do get flexibility both ways. So the answer is yes, there is flexibility, but I'd say it's marginal, because you're still bound to deliver a great IRR.
Yeah. So I mean, essentially, the point is, it isn't a free lunch, right? Or it isn't a blank check. You still got to merit your existence, right? Otherwise, they'll deploy the capital elsewhere, because ultimately, as you said, the family office is the business, and the business is in the business of making returns, right? Which I mean, and this is sadly the conversation that I have to have with lots of founders all the time, which is just understanding that, yes, venture is about backing great outcomes. That doesn't necessarily mean backing great innovation, although often that is a happy a result of backing great outcomes, because often those outcomes come through the innovation.
It's usually great innovation and or great execution. So
Yeah,
you need one of those.
Exactly, right. But the point is that venture is about making money. Right? So you got to remember that, I think, at the heart of things. And certainly I think, the more founders think about it from the perspective of what investors are looking for, the better their decision making, I think, both in terms of who they take capital from, but also how they deploy that capital, and how they think about utilizing that capital, deploying that capital within their business.
It's such a good point. I actually spend a lot of time with the founders we back, trying to have very open conversations about the motives and goals of all the different parties.
This is what needs to happen for us to get here, for you to be able to do that.
And which, by the way, might be different between the seed investor, the founder, and the Series A fund, because your fund size, your fund concentration, they all make a difference.
Yeah.
And that's okay. But I think it's always better to have transparency about that for the founder, at least.
Yeah.
So the different ambitions and goals that you're juggling.
No, 100%. And often conversations that we have with founders, they get really surprised when VCs, for example, don't follow on, right? Or are at the tail end of or don't follow on because they don't have the conviction anymore, or don't follow on because they don't have the capital, right?
Yeah.
And they're like, well, how can they not have the capital? Well, because they've got to go out and fundraise too, right? And I think it's naivety, it's lack of education, not in sort of the traditional sense, but just in terms of kind of how the whole ecosystem works. And obviously, I mean, a lot more founders obviously learn that on the hoof and internalize it early doors, but you still have, especially kind of very, early stage seed, maybe into Series A founders who maybe have taken capital from quasi venture or from angels, who don't realize kind of how the venture model works and how VCs think, and then get really confused when they get the outcomes that they end up getting.
It's opaque, right? And that's in part because, yes, there are some theories, and knowing about how a fund works, you can sort of think through academically what that means in terms of what they're looking for. But actually, the reality is you then have discrete decisions that are made at slightly random points in time, where, yes, there might be some academic theory about what people want, but actually, because you're making it at this discrete point in time, it's actually much more blurry, and it ends up being a judgment call every time anyway for the VC. And so I do think it is just quite opaque and often hard to predict exactly what's going on.
If it weren't, I think I wouldn't have so much fun. But anyway,
okay,
we touched on this a bit earlier, but I'd love to dive into a bit further, which is kind of this question around the commoditization of code. So as we said, the cost to build software is collapsing, right?
In theory.
In theory, right? And I mean, we've obviously seen Moore's law. That's been proven time and time again. No code, low code platforms. Now we've got AI, talent pools all over the world. I have a thesis, by the way, that sort of the UK is starting to look a little bit like the kind of Bangalore for the US, in terms of we have a cheap but talented pool of talent. So you can launch your business in the US, but buy your talent in from the UK and pay a third of what you'd be paying an engineer.
Yeah, interesting. I'd almost, that's one way of looking at it.
It also means that you could build businesses because it's cheaper to build.
I also just think European businesses are more capital efficient, right? You see that in the capital needed to reach $1 billion outcome is systematically lower in Europe than it is in the US.
So I guess so that's exactly the question, right? So do you think that's a golden era for capital efficiency, or is it, or does it actually make it harder to remain defensible, right? Where essentially anyone can pick up your product, your app, run it through, whatever you're running it through, and say, okay, just replicate this. And how do you think about that terms from underwriting a company when essentially the tech that they're building today could be either rebuilt by a decent team within 6 months or becomes obsolete, within 6 months. Because we used to talk about, in finance, if nothing else, right? The lifetime of a software asset, maximum 5 years, because you just couldn't predict thereafter what was going to change or what was going to happen. But it feels like that's compressed massively. And the lifetime for a software build today could be as little as 2 years or even less. So yeah, I'd love to, especially because you are an engineer or have come from that sort of a background. What are your thoughts?
Yeah, it's a great question. There's a lot to unpack in there. I think as we talked about earlier, and I won't sort of go over it, there is, in theory, you get this golden era of much more productive people across tech, GTM, everything, which should lead to more capital efficient businesses. But we're also seeing record levels of capital because everyone sees this opportunity. And actually, if you believe software can start to eat into the labor stack, that's such a big opportunity that there should be more money going after that. So I do think I genuinely believe there is a really exciting golden era here. As with any such paradigm shift, it comes with a lot more risk. And I think it's definitely true this is a more risky time, both for existing portfolio companies, which are probably exposed to more risk, but even new ones. Like you have to think about, I think you described commoditization and sort of the breakdown of code as a moat, to the extent it ever was.
Yeah.
And how I think about that is, one, probably even more focused on speed of execution and innovation than ever before, just because I think if you can move fast, these tools sort of accelerate that. And so we're really looking at teams that are moving exceptionally fast because we think they can continue to compound. I think secondly, we're looking at non-code moats a lot more than we used to. So is it things like the domain expertise of founders, is that very unique? So there's just a lot of know-how that you can't replicate with code.
That just on that point, sorry, it was really interesting. I was talking to a VC last week. She's over from San Francisco, and she looked at me and said, "Why aren't you building?" And I said, "What do you mean?" She goes, "My God, like there are people out there with zero domain expertise building like finance apps for CFOs, like just crappy spreadsheet sort of automation things, which are pretty useless because they don't have the expertise. You have all the expertise. Why aren't you building?" And I was like sat there going,
I got to say, I agree. I mean, I there's probably some bias in my own experience here, but if I were to set up something, I would look at sort of the office of the CFO. I do think there's a huge amount of scope for agentic software in that space. So I have to say, I agree. Should we stop the podcast now?
Yeah, no, gosh, I'm just going to have to go into therapy for a little. I mean, I try to build. So the problem is I tried to build in that space 2 years before AI was a thing. And I ended up winding the business up. But even today, I look at it and I'm like, there's either no opportunity or there's a massive opportunity, right? It's one of those like, no one wears flip-flops, therefore there's no market, or well, no one wears flip-flops, there's a massive market, right? And the problem is finance people just tend to be really, really a little bit curmudgeonly and a bit kind of stuck in their ways. They're kind of the original Luddites.
We talked about Avanti Law, the law firm and not my portfolio. I think actually that the finance office is a great example of a space where I think AI-enabled service makes a lot of sense.
100%, yeah.
So sort of human and AI agentic offerings.
So I think that's the point. It's often not it isn't a product in and of itself necessarily, right? I guess, yeah. Sorry, but yeah, that was that was me getting, again, very, very upset and emotional about that one point. But yeah, so you say so if you have massive domain expertise, and let's leave finance out for the second, but that becomes much more of a moat rather than the software, rather than a patent, rather than anything else. Like the fact that you have lived experience, worked in that domain, have built up the 10,000 hours, become an expert, whatever those numbers are, just gives you an edge in a world where if you can execute and move quickly, actually the building part of it is a lot simpler, at least to MVP, if nothing else.
Yeah. And I think, again, that's where this, coming back to this sort of power law question, where this is interesting is there are sort of domain experts in kind of smaller niches that wouldn't necessarily support a decacorn outcome, that back in the day would never have thought about building some sort of automation or software, because the cost of building it wouldn't be justified by the size of that niche. Actually, I could see a world now where you see domain experts in kind of medium-sized markets becoming entrepreneurs. I think that's really exciting, and as you say, that is a source of defensibility. We also look at other moats, so service wrappers, because they're actually hard to build up over time. Sort of talent magnets are actually defensible. Marketplaces, of course, anything with a network effect. Proprietary data is another one. And actually, hardware was always, well, not always, but hardware was largely frowned upon. But some kind of hardware-enabled AI, actually that provides a moat, because you've got to go and put the hardware out there.
Build the hardware.
Create a network of hardware out there. So we are definitely, I mean, we always looked at those things, but they're probably even more important now than they used to be.
And what are your actual thoughts on kind of this whole question of, so I mean, we had an AI expert on a few episodes ago, Andrea Isoni, and we actually had this whole conversation about, can you and sadly we use the CFO as the example, but can you build a virtual expert in that field? And his answer was resoundingly no, and the reason was everything is contextual, right? And so the point is, there's 95 or 90% of what a CFO does. It sure maybe can be ported into software of some nature, but that 5 to 10% is actually where the value comes from, which can't be then digitized, for want of a better word, because that comes from having been in the room, or the context, or the unspoken, or the human element, right? And that's kind of where I think we are probably also with the software side of things, right? So this whole question of the commoditization of code, and how will coders become obsolete, as we've both said, it's probably more a case they'll be augmented, because it's not about can you write the right code, it's can you write the right code in the right circumstance for the right thing, and do you know when 2 lines of code will do as well as 100 or whatever, right? Whatever that metric is. So where do you think will that, because the other thing I'll say here is, I've tried to get for hours on a Sunday afternoon, try to get Claude or I think it was ChatGPT that I was trying to use mainly, but even Google's FireDev. Can you write essentially either app script or VBA to create an Excel or a Google sheet, and even Google's own AI could not write particularly good code, or code that was certainly going to result in something useful. And so I wonder whether we are over indexing towards this. Well, actually, AI is just going to write everything. And whether that room for the human being in the loop is always, or maybe it is always just going to have to be a human in the loop. And that's kind of the way I think about law and finance as well, which is you will always need the human in the loop because there are human decisions to be made. It's not always logic-based, black and white.
Yeah, the short answer to that is definitely my view. But it's not a strongly held one because, frankly, at this stage,
could
who
change.
knows?
Yeah.
But my sort of, I guess, philosophical view is business and work is fundamentally human. There are human interactions, human decisions, and actually those are the interesting and important parts of the role. And most of us have grown up doing a lot of other stuff around the edges that we don't really want to do to enable that interesting and important part. And so I see AI as sort of enabling and augmenting that, but with that important, truly human bit remaining in the loop and being a very important part of it.
Allowing you to pursue the interesting stuff rather than the mundane.
Yeah. Exactly. Yeah. Exactly.
What's mundane in the what do you hope gets automated out of your role?
Well, it's a slightly circular one, but I think most of us, when we got into VC, we didn't think of ourselves as being sort of SDRs, which the reality is for a long part of your career, and actually in a small fund, your entire career, you still do. And there's you can do it for a bit, and it's quite exciting and fun. And luckily, the way the job works, you kind of go through cycles of different activities. So you never get truly bored of it, because then you actually find something and then you're diving into a completely different task. But that's the bit that, actually our whole team's still doing hundreds of cold emails. The weird thing is there's a sort of cycle here where AI can definitely automate that. Better data can make it more effective. And we're all doing responses. That. But actually, the more that happens, the harder it is to get cut through. Yeah. And so I think all VCs, ourselves included, thinking about, okay, well, in a world where people stop, there's just too many emails.
With all the same format. I had 3 this morning with the same, hey, XYZ from my team recommended I reach out to you, and it's the same email format down below. And it's like, that isn't the case. Like, I just ignore bin, spam,
exactly.
Right?
And the truth is, I don't know yet what the answer is. I mean, there are some funds, the tier ones, that have a brand name that will always attract them. There's some funds that are trying to create media assets, basically. And for the rest of us, I think for now it's a sort of reputation game. Yeah. Where, I mean, you mentioned some positive founder references. I actually think they're so powerful now, because it's those guys that will recommend you.
100%.
And so I think VCs are increasingly going to have to really think about that founder proposition and really nurture those intros and those references, because that's what gets cut through.
And often it's actually that reputational point. It's almost more what you do when you pass on a deal than what happens when you invest, right? Because I think a lot of founders take, you pass on my deal, therefore you're a shit. That's kind of like you must be a rubbish VC because you pass on my deal. But if you pass on a deal and you can actually give something more than, it's not the right stage, or it's not, or it's a bit too early, or we're cheering you from the sidelines. Like, if you can actually say, well, look, we looked at this, we are looking at this space. However, we feel that this isn't right because we think the founding team is too weak, or we think these are our, this, after we have gone through the process of doing some diligence, is our rationale. Then I think actually, if coming at it from a founder's perspective, I'll be like, okay, that's great, because I can work on those. Those are actionable insights. And actually I'd be like, great. You didn't waste our time. You gave us feedback. It was a quick no, hopefully, rather than a protracted maybe. And from a reputational perspective, I think that's the biggest thing that founders index for, which is how quickly can you get me to a yes or a no? Yeah. Because if you can get me to a yes or a no quickly, I know what I do next. If it is a hang around for 6 weeks whilst I'm making up my mind sort of thing, that's where I think founders get really frustrated, and where reputations start becoming a bit harder to manage.
Yeah, and it's really hard to get it right, to be honest with you. I mean, I think we're pretty good at, when we say no, giving clear reasons, because I completely agree with you. That's the right thing to do. And we've actually had feedback of, oh, thanks, that was a really clear, helpful response. At the same time, I've definitely been guilty of saying I'll get back to someone, probably thinking, oh, it's not quite right for us, meaning to get back to it, and it just never getting back up the prioritization, so you don't respond. So I'm sure there's founders out there who think, oh, what dick, he didn't reply. Yeah. But in general, I think you can tell the people that are trying their best that when they do respond, it's clear that in general they're trying to move, be quick and clear.
Again, as I say, that was, your name came up several times when I asked the question, who should I have on the pod? And what that essentially means to me is, reputationally, your reputation is strong, right? And as someone who works in the ecosystem, works across, we have multiple clients across the ecosystem. I know multiple VCs. It's hard. And to your point, it is hard because you can't be everything to everyone. Like, I mean, there are instances, and I've seen this on, Twitter in the past, where, founders come up and, in this particular instance, a female founder, and said, well, these guys, isn't it great when funds that say they invest in female founders don't invest in a female founder? And I'm like, you're doing a massive disservice, because because I knew exactly who they're talking about. That fund does invest in female founders, but that doesn't mean they can invest in every female founder, right? And to your point, reputation becomes massive, and it's very, it takes a lifetime to build a reputation. It takes 5 minutes to break one, right? So, and I actually think in a world of AI, I keep getting asked, when am I going to turn this into a, essentially avatar-driven, AI-driven podcast? And I'm like, never.
Yeah, good. That's good to hear.
Right?
As you were saying that, my heart's saying it.
No, I'm just like, well, I think in a world of AI, authenticity and a human approach is actually what does build trust and does build reputation. Now, sadly, we may get to a point where the avatars are so realistic that it's, again, we're in that, that beyond the uncanny valley. And whether people will be able to differentiate that becomes a different matter. But yeah, I mean, for me, I think the beauty of AI is it hopefully allows, exactly as you said, humans to be more creative around the things they enjoy doing, and use their human creativity to do more rather than the drudge, right? Like no one wants to do admin. I want to get one more topic in,
okay,
if I can, because I feel like there's a whole bunch of stuff we could talk about beyond what we already have. Let's talk about Europe, because it's dear to my heart. As I've mentioned to you, my wife's Italian, and I have I have this constant not love-hate relationship, but just this this feeling that Europe is missing a trick, right?
Apparently Italy's VC scene is absolutely thriving this year. I was actually on a podcast a few weeks ago with the Super Seed guys, and they had that fact. I think it was the fastest growing ecosystem
from a really low base. But yeah, no, it is. I mean, they've got accelerators popping up in Milan. There's stuff going on in Florence, stuff going on in Pisa. Yeah, for sure. And I've had multiple Italian VCs on the podcast actually in the past, purely because I was like, can I find one? Yeah. But the head of Sony Innovation Ventures is based out of Florence, for example, right? And I think Italy has a very strong history of, private equity was invented in Italy, right? Like it understands finance. I think the problem is it's very slow. It's got a legal and contractual culture that kind of doesn't really work with venture, especially when it comes to hiring and firing individuals, which sadly is something that all founders have to do at some point. And I think sadly, again, because money is quite sort of concentrated amongst a few very, very wealthy families, although very sad to hear Armani passed away recently. Because the money is concentrated amongst just a few families who aren't tech first, they're all old school industries. There is this I don't know, wariness around technology and or lack of understanding, or whatever you want to call it. But look, there is more happening. And again, one of the VCs we had on, they are backed by the Benetton family office, right? So hopefully that will continue, and maybe that will change my future decisions, and my wife might be made a bit happier. But look, you've raised the alarm on Europe's chronic underinvestment in hard tech infrastructure, which actually we haven't really talked about on this pod before. It's always been around kind of the financial side around capital markets and the depth of capital we have here. But you're talking about chips, compute, energy. So at what point do we hit a choke point? And is Europe at the risk of becoming, again, as we said earlier, the service provider to the US and China rather than the birthplace of the next global tech giant? How do you think about that?
Yeah, it's a really interesting topic. And I think as we enter this sort of golden era, if you want to call it that, of AI opportunity, Europe has a lot going for it, right? We do have a lot of very high quality talent. We actually have a lot of experience. There's been lots of successful businesses here. We have an entrepreneurial culture, actually. And we have a lot of funding, not where the US is, but that gap is slowly closing over time. And we do have a lot of experienced funds and capital here. So a lot of the ingredients are in place. The thing I worry about is literally the physical infrastructure, because if you look at the pace of AI development, you're talking about sort of a 30 to 40% CAGR on demand for the fundamentals, so power, compute, like literally chips, and data center build out. And unfortunately, I think Europe is slow off the mark on all of those things. We have higher cost of power. We have restrictive planning laws that are slowing down data center rollout.
NIMBYism, yeah.
And we've been slow to put in big orders of NVIDIA chips, for example.
Yeah.
Certainly not just versus the US, who are always going to be ahead, frankly, but even versus countries like the UAE, who are really leading the way on this.
They've absolutely kind of come out the gates over the last few years and just said, we're open for business.
And so, at one level you could say, well, why does that matter? I think the best version is we keep the talent, we keep the entrepreneurship, but there's just some value leakage as we have to rent compute data centers, power from other countries, and probably that means the hyper-scaling foundational companies get built elsewhere. But you could still have a thriving application layer ecosystem in Europe. The sort of more doomsday version of it, if you actually believe a choking point happens where compute or sort of AI compute actually is structurally slower here or structurally more expensive, does it become harder to innovate here, and thus you actually get talent flight to some of these other countries? And that's
which has always been the risk,
always been the risk. And that's for sure one of the things. I think, again, coming back to the UAE as an example, because it's probably the place where the change is more sort of recent versus the US, which has always been ahead, China, which has always been ahead in some regards. But, they are trying to attract talent away from Europe, and so that's the more existential risk that I see. There have been some positive movements, definitely, in recent times, but we're definitely off to a slow start. So I am worried about that, and I think it will, if this sort of choke point that gets written about were to happen, I think that is a few years window. It's not sort of long distance.
Yeah, it's sooner than
concern.
It's sooner than maybe some people think about it. I think, just addressing a couple of those points, right? In the past, my whole thesis was capital and talent follow each other. So if you have capital flowing out, talent will flow as well, and vice versa. Yeah. Now we've got capital, talent, and infrastructure, and one can debate how true the newspaper headlines and so on are, but part of the reason that there is this noise around people leaving the UK today, for example, is around the infrastructure as much as anything else. Yes, okay, there might be some tax stuff, there may be some other stuff, but it's also an infrastructure driven. Okay, that's in the more general kind of public infrastructure.
Oh, I see what you mean.
Yeah. But actually, but that's because most people aren't thinking about compute power, right? Like that's just not on their radar. But it'll get on their radar when their costs start increasing, right? Because at some point those costs will increase because, at the moment the cost of compute is, it is, but we know that companies like OpenAI are talking about building massive chip factories, are talking about building massive data centers, are talking about all of this sort of stuff.
And countries need to have a strategy and a proposition to those companies why you should build here. You have to go and court them and persuade them to come to your country. Yeah. Because again, the rate, I don't think we've really had this before, where you can't actually build the infrastructure fast enough for what's needed. Yeah. And so that it does become a physical constraint. And so
presumably
more than ever
the
before,
only time might have been like when Ford came out with a car, were there enough roads?
Yeah. I mean, yeah, probably.
I don't know the answer to that, by the way. But sorry. But yeah, but not even should we be courting them and showing that we are the right place, but also from a sovereignty perspective, from a defense perspective, right? These are things that we need not to be reliant on others for, as we've seen with energy, right? As we've seen with defense and actual, physical defense. I think for far too many years, because of the global kind of ecosystem, there's been a lot of, kumbaya and, we'll all support each other and help each other out. And that's great. And I'm definitely not an anti-globalist, but that does not stop individual nation states from requiring their own solutions to these things where they can afford them. And exactly to your point, right? Like if we can attract the Googles and the Facebooks and et cetera to come and set up shop in King's Cross, like we should be able to do these other things. I think the problem is, and again, without getting political about it, because we're seeing it with things like, solar farms and wind turbine generated energy, 2 or 3 of the prominent political parties are just not happening, not in my backyard, right? Which just throttles your ability to do anything, and it actually makes a country look somewhat unambitious. But part of the reason for that is you have, and I think the disconnect is so many people, and I think so many people are disconnected with what is actually happening within the technology sector, within and from a global perspective, right? Like if you're going out to some of these, left behind coastal areas, coastal town, like they're not sitting there thinking about venture capital. They're not sitting there thinking about, who like where Facebook is hosting their content. Like they are literally just figuring out, okay, where am I going to work? Right? Where am I going to live? How do I keep my town safe? And therefore, even if you say, well, okay, this is going to create a bunch of jobs. It's like, yeah, it's going to create a bunch of jobs because it's going to ruin my otherwise idyllic lifestyle sitting on the coast, right? And I think in the UK, this is the issue. Like, do we want, England's green and pleasant lands, or is it the dark satanic mills? Like that's the kind of, I think that's kind of where we're at. We've got to figure out which path we're willing to choose, and what are the trade-offs that therefore means, right?
Yeah, it's always about trade-offs, isn't it?
Yeah.
I think that the silver lining is, I do think we have a lot of potential wind farm capacity, and with some of the innovations that we're seeing in batteries at the moment, that could really unlock some renewable power in the UK, which would at least solve one part of the equation there.
We actually just talked to a company that has figured out a methodology to recycle battery powder for reuse in batteries, which is because at the moment it's just getting dumped, right? Like, so that cannot be a bad thing, and it's a finite resource. Okay, I'd love to round off with a couple of additional questions, which we do ask everyone who comes on the podcast. What is one thing that you have a contrarian conviction about from any area of life, whether that's work, politics, socially, or at home?
Oof, put me on the spot there. I mean, to be honest, I wouldn't describe myself as a contrarian.
Okay, excellent.
I think actually the most interesting debates are in the nuance,
in
100%. And around consensus, and I actually genuinely really believe that. If I was to try and pick one, I mean, we talked a lot about AI on this in this session. I'm definitely an AI optimist in sort of the midterm, 50 years or so. I think it is going to create a period of, or has the potential to create a period of abundance for humans. But if I really look forward and I get really sci-fi, the way things are going, I do see a convergence of humans and machine, which sounds a bit crazy, but it's happening with Neuralink already. And I don't like the implications of that in terms of convergence, sort of homogeneity, and what that might mean about the essence of humankind. So it's a bit of a sci-fi one, but whilst I'm a sort of
less sci-fi than it was 10 years ago, right?
Yeah. So whilst I'm a near-term optimist, I do worry about sort of where this all ends over the very long term.
Okay. I might end up taking that question out in future episodes, because what I've learned is, despite, venture being theoretically about not necessarily always contrarian, but certainly having convictions and so on. But I think there is this thing where over the years, being contrarian has become a performative stance rather than an actual stance, right?
Yeah.
Like it isn't about I am convinced that this is the case and I'll stick to my guns. It is, I'm going to say that I think this is the case just because I sound different.
I've got to say, I have to say, I find it a bit annoying, actually, the whole concept of contrarian views, and
because there is so much nuance in the middle, as you said.
Yeah, and a lot of the venture, it's about different views. Do I think, you and I can meet the same founder and come to a completely different view as to whether we think they'll be successful, about how the dynamics of that market would play out, and that's where all the interesting stuff is. I'm not sure I'd call that sort of contrarian views necessary, and actually I think most VCs are sitting around thinking about the same kind of things and just coming to slightly different views of how things play out.
The approach may differ, and therefore the outcome may differ, but actually the kind of directionality is the same. No VC is out there saying, I'm going to back the shittest businesses that, they're going to return $0 to my LPs and hope for the best. Like, that is, I mean, maybe that is my strategy. Maybe that might work. Note to self, that's something we should try in the future. One final question, Joe. So we can get to know the real you, although I think we've gotten a long way towards that already today. What is something that moves you the most emotionally?
I think I'm a reasonably emotional person, so there's probably quite a lot of things I could say. If I had to pick one, probably nature, actually. I'm a big lover of nature. I love being in the sea, surfing. I love climbing mountains. I go to Scotland every year, and you can really get out into the hills on your own, and I find the size and beauty of nature very, very moving.
Amazing. And again, I mean, I would hope no one would disagree with that. I similarly, like, as much as I love cities, I think getting out into the open space is amazing. And I certainly hope that you get to set up that windsurf shop down in Cornwall. My daughter was at university in Penryn, so we headed down there a few times. And it is just it is a beautiful part of the country. And I think it is, one of these spaces where you can live just the most idyllic of lifestyles. It really is stunning. Joe, it's been absolutely fantastic having you on the podcast. Thank you so much for spending the time with me. For our audience, where can they find you online? Are you on LinkedIn? Are you on Twitter? Where can they find you on the internet?
LinkedIn and our website, which has my email.
Amazing. Well, thank you so much for joining me. It's been an absolute blast.
Pleasure. Thanks for having me.